We want to get right now to our first Squawk Box newsmaker of the hour. Joining us from the Greenwich Economic Forum, Ray Dalio is here, founder of the hedge fund giant Bridgewater Associates. Good morning to you, Ray. Thanks for joining us.
Good morning, and welcome to Greenwich, Connecticut.
Thank you for that. Want to get your sense of where we are in what seems like a very complicated market these days. We have a lot of volatility. We have questions about tariffs and trade, of course, and interest rates. You've always put the markets in the context of the economic machine. So where are we within that machine?
Well, you know, there's the short-term debt cycle, long-term debt cycle, and productivity. We're in the late stages, maybe the seventh, eighth inning of the business cycle, right? We're in the part of the cycle where there's been a lot of monetary easing. Central banks bought $15 trillion worth of assets, pushed them up a lot. We had the benefit of a corporate tax cut, all that stimulation, and as a result, we're in the late part of the cycle where there's a tightening of monetary policy, and so it's kind of the late part of the cycle with assets fully priced. And then in terms of the longer-term debt cycle, we're at a point where interest rates are comparatively low. The capacity of central banks to ease monetary policy is limited. United States, it's limited. Other countries, it's limited. So that's where we are, and we're in a position also where we have the emerging power on China competing with the United States, an established power, as an effective competitor, and that's very much like the late 1930s. So that's where I think we are.
Let me just go back for 1 second. I mean, the 1930s are a complicated time, but specifically on the interest on the issue of the Fed and interest rates in terms of where we are in the cycle, there is a debate, as you know, about whether interest rates should get hiked and how strong the economy really is or isn't. What do you think?
Right now, the Fed expects to raise one more time this year, and probably two or three times next year. I think that there's a problem in terms of asset prices. I think that rate of increase would not be able to be made because we've raised interest rates to a level where it's hurting asset prices. We have now a flat yield curve. We have, in other words, you can now get in a 2 to 5 year note, you can get about 3%, and you have no price risk, no material price risk. So we're in a situation right now that the Fed, I think, will have to look at asset prices before they look at economic activity. It's a difficult position because that stimulation that they have in the form of those tax cuts is a big stimulation into the capacity limitations as we have low slack, so that the economy itself will pressure them to raise rates. I think probably too much. I think we have a supply-demand problem for bonds that'll particularly come next year and the year after. In other words, because of that tax cut and the deficits, we'll have to sell a lot more bonds, and the United States itself can't absorb that quantity of bonds. So we're going to have to sell those bonds to investors in other countries. You look at the portfolios of those, and they have a lot of those, they're sort of overweight in that bonds. So I think there's a supply-demand imbalance and a difficult position for the Federal Reserve. I think it's a risky situation.
Just to put a fine point on it, though, it sounds to me like you're recommending that if you were Jay Powell, you might slow down, similarly to what the president has suggested.
Yes, I would look at what is discounted in the curve and realize that that's discounted in all asset prices. It's discounted in bonds, it's discounted in equities, it's discounted in real estate, private equities, that rate of change in there. And I would keep it certainly not faster than that, and I would keep it probably less than that. I think the risks are asymmetric on the downside because if we have a little bit overshoot in the inflation rate, you're going to be in a position where it's not going to be a problem. Who cares if you have 2.5% or something? It's not going to run out of control. But if you have a downturn, first in asset prices, and then you have a downturn in the economy, it's an asymmetric risk. It's a serious risk. We have an economic polarity and populism, which is an issue. If you have a downturn, I think the conflict is going to be greater. I think that's a big issue. And I think also the tools are not as effective on the downside. So I would err on the side of being easier in monetary policy.
Well, let me ask you a question.
Discounted in the curve.
If you're concerned about asset prices, one of your peers, Dan Loeb, recently just wrote, "We have delevered our portfolio, reducing our tech exposure meaningfully and grown our short book. We expect to be net sellers over the next few months if markets rally." As an investor out there right now, how cautious are you?
Well, as I say, I think we're in the. We've gotten a lot of the good news behind us, and I think that assets are fully priced, and I think there's asymmetric risks. So, like I said, I won't talk about our positions, but I think I think the upside position is not as strong and relative to the risks.
Ray, it never made that much sense to me, but you said we don't have the tools to address a downturn. Some people think we need to raise rates to get to a point where we can cut them, if we need to cut them, which I don't know if does that make any sense to you, that we need some dry...
That sounds like pretty bad logic to me.
But you know what they're saying. If you're up there at 6, you can keep cutting until, but when you're all the way down near 0, you don't have a lot of cuts that you can make in case there is a downturn. But I don't know, to go up to come down is crazy.
Yeah, I mean, but I'm telling you that what's built into the curve, what's built into all the markets is the existing interest rate.
Right.
So you raise that way, that's not good. I think the Federal Reserve should use more macro-prudential policies. In other words, there are parts right now. There are some bubbles emerging. There are some issues in terms of places. But macro-prudential policies, what that means is it has a regulatory authority that can deal with certain bubbles as they're emerging to be more targeted than using interest rates as a whole.
Hey, Ray, talking about bubbles, do you worry about high-yield bonds? We were having a conversation earlier today, actually, about General Electric, a Connecticut-based company whose debt has come under a lot of pressure of late.
Boston-based now.
Now Boston-based, yeah.
A lot of the high-yield debt market has gone into leverage loans and CLO, and so as a result, it's off balance sheet. I mean, it's private, and there are parts of that market more than the particular high-yield debt market. Although, if I was to take double B, some triple B types of debt, I think that it's more than fully priced.
Right.
But Ray, I'm wondering if you can shed a little light on what might happen to the junk market if GE heads towards junk status. I mean, it's kind of trading there based on the credit default swaps at this point. It's headed that direction. If that were to happen, you're talking about GE becoming 10% of a $1.2 trillion market, and that seems like an awful lot to absorb. What kind of aftershocks would that potentially have?
Because I think GE's problems are well recognized in the market,
right,
and is probably reflecting those. Because there's a lot of index funds or ETFs or where the investor experiencing a sting looks at that asset as a number of assets, you could have more contagion to the other markets as they say, I don't want that kind of fund. And then even less stressed funds would experience some sort of contagion. So, yeah, there is that kind of risk.
Ray, I wanted to ask you about China. I know you just announced a new fund that's actually going to be based in China, and you've spent a lot of time there. Obviously, we are in the middle of what some have already called a trade war, given the tariffs. But just speak to what you think about the potential trade war and how you think it will ultimately shake out.
I think this is the trade war, I think, could be worked out. Trade balances, I think from the Chinese perspective, American perspective, but it goes way beyond the trade war. You know, there is this now competition, real competition in the world in supremacy. This is the first time since the 30s that we've had an emerging country that is a comparable power, really, to the United States, and there are issues there. So those issues have to do with property rights. They have to do with access, competition. They're geopolitical. There are a number of things. I think that the trade issues can largely be dealt with, but it is it's a broader issue that'll be with us for a long time. And I think what most fundamentally it has to do is a different approach to life, a different approach to how they think governance should work. But as one of the Chinese leaders described, it's basically a top-down versus a bottom-up type of approach. If you were to look at, let's say, gaming, by way of example, playing games, video games, and you go in China, they will have a point of view as to what their kids should watch on video games. It exemplifies this. And so they will control it can't be more than a certain number of hours, and it can't be these types of games and so on. And so that will be like a top-down decision. In the United States, we would not want the government. Right. The system is a bottom-up. And so it is really, it goes back to Confucius in 500 BC. It's a very different approach. And that is, so when you look at the 2025 plan in China, the government believes that they should have a plan for making China great, and they work that plan, and then they'll have coordination between the parts. So yes, the military will cooperate with the tech companies and so on. That kind of activity is objectionable to the United States because that is viewed as something that is different. So that kind of identity issue or those types of rivalries will be with us for a long time, right, even though the trade issue itself, I think, can be dealt with.
Ray, before we let you go, I want to talk about a perhaps more local issue than this global issue, which is where you're based right now and the conference that you're attending. And I know there's a number of big speakers, including yourself, later today. This is the Greenwich Economic Forum. But there's a big question right now about hedge funds and Connecticut, the state of Connecticut, taxes in Connecticut, whether it's actually the right place for firms like yours to be based, given the tax rates there. How are you thinking about that, given that some of your peers have left the state?
Well, you see what Greenwich, Connecticut is. I mean, it's a fabulous town right outside New York City, so easy access to the city, fabulous community, and then its vitality it's great intellectually. It's very stimulating. There's a culture here that is great, community and all of those things. And then there's this issue of the state issues. I think that the state is going to approach this in a very effective way. We'll see. There's a new government, and so we'll see how. But the approach that even New York took in terms of Long Island City and the bringing in, creating a tax-free economic zone. For example, you could take Bridgeport, and you could take New Haven, and you could take Hartford, Connecticut, and make those tax-free economic zones and bring in vitality to the state. Yep. I think that it's really going to be a test of the cleverness, and it's an issue that they're going to have to deal with one way or another. It could be very harmful to the state. It's a risky issue because the polarity between the high-income areas and the other parts of the state, which are really suffering, cannot be cut.
Well, before you pull up stakes and move down to zero-income tax Florida with Tepper, you might wait till for the recounts. I think, right? Just I don't know, maybe wait a couple of weeks before you decide.
He's not deciding. He's staying there.
I know.
Well, by the way, what do you think of some of your peers who have moved to Florida?
The joke's on them, maybe.
Well, I think the tax issue is an issue of consideration, and then the worst case scenario is a bad scenario for it's not just Connecticut, but some of the Northeast. New Jersey's a good example, and New York, different parts. And I think that model has to be dealt with by bringing in a lot more revenue. By creating, a different approach, but it's understandable. It's not just, it's the whole area. Wherever you have tax, San Francisco's dealing with the same thing with like Nevada.
Ray,
it's a national issue.
We've only got a few seconds, but very quickly, what you're talking about, creating these zones, is coming under protest from people here in New York City right now.
I'm sorry, I didn't get that. Say it again, please.
The protests, people are protesting the tax giveaways to these wealthy companies, like what you mentioned for Long Island City.
No. Yeah, I'm saying, I think if you take, I don't think you can cut taxes. You have to raise tax revenue.
Right.
The issue of raising tax revenue is it's much the same as if we're looking at Amazon going to Long Island City.
Right.
Is that going to be a net benefit, or is that not going to be a net benefit? And you got to take a sharp pencil. If you take a free economic zone, I've seen this happen a lot of places, and the impact of companies who are not there coming into a tax-free economic zone brings net revenue. And we need net revenue, because you can't cut expenses. It's not humane. And you can't raise taxes, because if you raise taxes, people are going to leave more. So you have to have something like that.
Ray, we want to thank you. It's a pleasure. You have to get to a panel. We have some breaking news to get to as well. We want to appreciate your time and thank you as always.